Welcome to this explainer. Today, we're taking a look under the hood of Allegion's second quarter 2026 financial results. We're going to take all that dense, complex data from the recent earnings call and translate it into a clear, vivid picture of the company's financial health. Look, if you follow the security and access solutions market, you already know Allegion is a massive player. But their latest numbers, they reveal a fascinating story of strategic maneuvering that you definitely don't want to miss.
So, here's our roadmap for today. We'll kick things off with the Q2 2026 headline results, then look at where the money goes, check out the Americas acting as their growth engine, discuss how they're navigating international markets, and wrap up with their overall financial health and outlook. We're taking a top-down approach today to make sure everything clicks into place, starting with the massive headline numbers and finishing up with a look at their overall balance sheet. All right, let's jump right into Section 1, Q2 2026 headline results, unpacking the macro numbers. These macro results showcase some seriously strong execution by the Allegion management team. The absolute biggest takeaway from this entire report: Allegion is operating with so much confidence and momentum in their core markets right now that they are officially raising their full-year outlook for 2026. I mean, that's not just a minor tweak. It's a massive signal to the market about how strong they expect the back half of the year to be. And that confidence? It's fueled by a pretty staggering figure: $1.15 billion in Q2 revenue. To put that into perspective, we're talking about a massive 12.7% increase year over year. Crushing the billion-dollar mark in a single quarter is a phenomenal achievement, and it really highlights the sheer scale they're operating at right now.
But hey, it's not just revenue for revenue's sake, right? Profitability is scaling beautifully right alongside it. Their adjusted earnings per share hit $2.40. That is a super impressive 17.6% jump from Q2 of last year. Operating income alone delivered 34 cents of that growth, which proves their fundamental day-to-day operations are highly efficient. They aren't just relying on clever accounting tricks. So how exactly was that 12.7% growth built? Well, it's a really healthy, sustainable mix. It's not just a company jacking up prices to beat inflation. We're looking at 6.9% organic growth, completely driven by the Americas region. Add to that 3.3% in price realization, meaning they successfully passed on price increases to the market, solid volume increases of 3.6%, and some strategic acquisitions that padded the top line by another 5.1%. It's a true multifaceted growth engine.
Moving on to Section 2, where the money goes: capital allocation. Because bringing in capital is great, but how a company deploys it is what actually determines its future success. Taking a look at their capital allocation framework, Allegion put about $120 million to work in the second quarter. They are actively balancing shareholder returns, paying out roughly $47 million in dividends, which comes out to 55 cents per ordinary share, with some heavy, forward-looking investments right back into the business. Specifically, they've deployed $70 million year-to-date, targeting high-tech acquisitions and expansions in electronics and mobile credentials. In plain English, they're making absolutely sure Allegion leads the global charge to ditch those clunky metal keys so we can unlock everything with our smartphones. All right, let's pivot to Section 3, Americas, the growth engine. This region was the absolute powerhouse of this earnings report. The Americas segment literally roared ahead this quarter, posting an 11.8% total revenue growth. That surge pushed their regional sales from $821.5 million in Q2 of last year up to a massive $918.6 million this quarter. When you dig into the why behind that success, the growth is structurally rock solid. It's driven by robust 8.9% organic growth across both non-residential and residential sectors. Plus, they're seeing low-teen surges specifically in electronics. On the margin side, they caught a $10.8 million tailwind from price and productivity outpacing inflation. Basically, they're keeping costs in check while brilliantly scaling up their high-tech product lines. But of course, the global picture is never totally uniform. Let's look at Section 4, navigating international markets. When we look overseas to the international segment, we see a vastly different environment that management has to navigate really carefully. Comparing the two regions gives us a much more nuanced view. At first glance, international technically saw higher total revenue growth at 16.2%. But if you look closer, their organic growth actually declined by 1.2%, and their operating margins contracted by 70 basis points, or 0.7%. That is a pretty sharp contrast to the organically thriving Americas segment. The real story behind those international numbers is a lingering weakness specifically over in the European markets, which is causing a 2.0% volume decline. This tells us their double-digit revenue growth internationally was almost entirely propped up by a 14.3% boost from recent acquisitions and a 3.1% favorable currency exchange tailwind. They also took a $2.5 million hit related to inflation and investments outstripping price and productivity over there. Okay, let's zoom back out for our final section. Section 5, Financial Health and Outlook. What does the bedrock of the company actually look like, and what does it all mean for the rest of 2026? Looking at available cash flow, there was a slight 5.3% dip, dropping from $275.4 million last year down to $260.8 million this year. But don't panic. Management is very clear that this isn't a fundamental flaw in cash generation. It's simply about the timing of sales and receivables, along with a bump in working capital mostly tied to those recent acquisitions. Ultimately, the balance sheet is incredibly healthy. Their leverage ratio is sitting at just 1.6 times, meaning their debt is very manageable compared to their earnings, and that's down from 2.2 times just a year ago. That gives them plenty of dry powder to keep aggressively deploying capital. And because they're on such solid financial footing, they are confidently affirming their strong full-year outlook of converting 85 to 95% of adjusted net income straight into cash.
So as we look ahead to the next quarter and beyond, here is the defining question for you to chew on. Will the explosive, tech-driven organic growth in the Americas continue to completely overpower the sluggish volume realities in the European market? Well, with Allegion raising their guidance and doubling down on digital access, they certainly seem to think so. Thanks for joining me for this explainer, and definitely keep an eye on how these strategic investments play out in the months ahead.